let's look at Chinese real estate. So first off, read this disclaimer carefully and do your good deed of today by liking and subscribing. So we go to the real estate sector, and here is China. So we do have, we don't have much, but 2.6% here from the low, and the biggest haircut of them all. But I guess you know what that means. It could mean that we have some interesting opportunities. Okay, so this is the big picture weekly data points. We do have some kind of time cycles here, but they have differed a bit in duration. So it's Global X, MSCI, China Real Estate ETF. As you can see, price is currently at a key low. So this is a very critical level. It has held many times in the past. So the primary assumption is that this level, it should hold. If there are bulls out there, they should use this level to rally. When we also look here at the RSI, it is at a very key level that has attracted buyers, in the past, here as well. The only time we were more oversold is here. So this is the point, during this capitulation low here. So yeah, as far as buying low and selling high, this is definitively a low, but it is a very critical low. If we do see a break of these key levels, then they can become a resistance, and that would not be good news for the bulls. You could argue that we are forming a double bottom, or I guess even a multiple bottom. You could be like 1, 2, and 3. I think I would argue that we have a basic double bottom, like here. And this is sort of like, the car that can propel us to, future gains to the upside. So that would be my primary assumption. We also here have these very low RSI levels, and also look at the PPO. We have been lower before during this capitulation low, but generally speaking, in a very large majority of times, this kind of PPO and RSI, it forms lows. We are below all the key moving averages. Then again, there is virtually no correlation. I mean, like there's minus 6% negative with the S&P 500 short term. Long term, we don't have data. It is interesting, I must say. So yeah, I'm leaning technically bullish here, but it is speculative. It is very contingent on these lows actually holding. A break here would definitively make some key holders freak out. When we look at the seasonality for this one, we only have 3 years. However, the data we do have for July is constructive. August is the weakest month. That is not ideal, but we don't have that many years, so we need to be super careful about drawing any conclusions when we have such a paucity of data. When we go here to FinWiz, we see trend lines. They do draw a trend line here, so it is a key bottom. We do have a bunch of resistance above us, but currently this is looking interesting from a more bullish perspective. So let's go here to ETF database. So I am now comparing it against the VNQI, which is the Vanguard Global X US Real Estate ETF. When we go here to performance and look at the price earnings, it is much lower here for China. So the difference in price earnings is, so the VNQI is 144% above the China real estate ETF when it comes to price earnings. So you could definitively make a value case here for China. One of the issues, however, with the Chinese real estate market is that the economy in China is obviously very different from what we have in many other countries. Hence, there is always the possibility that there's unknown risks. Then again, because the Chinese political system is It's very strong, it can do a lot of things other systems can't. That can also help limit potential downside. So it's sort of like I said, having that kind of political system, it's a bit of a double-edged sword. On the one hand, there can be a bunch of malady, of sickness in the sector that is frankly just hidden. Then again, the system is far more able to actually deal with black swans. The dividend yield is massive, so you only get a meager 0.9-ish% yield from the VNQI, but China gives you 5%, so the yield is really, really good. Going here to the holdings, you can see, the mix. I'm not familiar with these names. So let's go further down. Let's look at market cap. Yeah. Mid cap and large caps dominate. A tiny selection of small caps, but basically it's about the large and mid caps. A bit more diversification here in the VNQI. Looking at the country breakdown. So here in the VNQI you have Japan, Hong Kong, Australia, United Kingdom, China, Germany, Singapore, other, Sweden. So you have a very broad mix. But you can see here that developed economies do dominate. Here you have, Hong Kong and China. So definitively you do have that specialization. And China is significantly bigger here than Hong Kong. I gotta say this is very interesting. As far as buying low and selling high. I mean this is definitely at a key technical low. The issue is that if we do see more weakness, then we could have a pretty bad situation, because the expectation is certainly that this horizontal level is going to hold. That is what the bulls are betting their money on. But if it doesn't, it means that there's a fundamental change. And that can become a self-reinforcing feedback loop to the downside. But yeah, I would lean bullish here. I just would. The yield is also very, very decent. I mean, you do get a 5% yield, so let's actually measure how much of a buffer that is. So, yeah, 5% is that. So even if we go down, yeah, like here. So let's zoom out a bit. So the yield would compensate for losing these technical levels and even this one. So yeah, I would lean bullish. Let's quickly look here at VNQI. So you see that this one, it did meet some resistance, did not break out to a new high. Look at II. Here is the VNQ, that is for United States, the Vanguard Real Estate Index ETF. Here we do have a breakout. So you see that this is definitively the opposite of what we saw with the China real estate ETF. So this is elevated risk here for bulls, not much value left. This is clearly something very, very, very different, for sure. There is, of course, something to this idea of buying the winners. There is, but clearly it isn't that simple, because if it was easy to beat the market by simply buying stocks that are breaking out to new 52-week highs, then you would easily have hedge funds just doing that and consistently beating the market. The very fact that you don't have that gives you a bit of a hint that it isn't that simple. You can't simply beat the performance of the market by buying stocks and sectors that recently broke out to a new 52-week highs, or that are emerging from breakouts. Because if you could just buy breakouts and beat the market, then guess what? Hedge funds would do that, because it's a very simple strategy, easy to put into a scanning system, and you could, be, the king of the hedge fund world. But they don't do that because it simply isn't that simple. The paradox, is the magic of percentages, and that's something I have seen shown you previously. You get much bigger moves. It's easier to get a bigger percentage move from a low level than a high level, and that is why some of the top performers, they do buy low and sell high.